The Gamestop short squeeze, the silver short squeeze, Chamath Palihapitiya's interview on CNBC. Wow, what a time to be alive. I mean, unless you've been living under a rock for the past couple of weeks, you know what's been going on with GameStop, AMC, Melvin Capital, and the great short squeeze of 2021. Well, that's what I'm calling it at least. So instead of adding to the long list of videos here on YouTube, just summarising the situation, I thought I'd take a slightly different approach here and focus on what Chamath Palihapitiya has said about the situation. Why? Well, because other than just being, a genius billionaire, Chamath went on CNBC recently and gave one of the most devastating interviews that you'll ever see. He talks about how Wall Street simply discounts the ability of the average person like you or me to carry out good research, how they aren't happy because they lost out this time, and the absolute joke the platforms like Robinhood stopped people from buying these stocks when it mattered most. I'm also going to add my own thoughts and provide a bit of commentary throughout. So let's get straight into it.
I have a hard time believing, you suggested that there's, a good amount of fundamental research going on underneath the GameStop Reddit situation. Do you truly believe that there's actual fundamental research? Not to disparage in any way the people who are actually making these trades, but this seems to be momentum rather than a deep fundamental analysis.
Scott, there's momentum in traditional hedge funds and how they move stocks as well. But it's really disparaging if the starting position is these guys can't do the same quality of research as an analyst in a fund. That's just not true.
I didn't say that. I didn't say they can't do that kind of research. I'm questioning whether they're actually doing the research when it comes to things like GameStop and AMC and some of these other things.
There's a distribution. And obviously at one end, there are fundamental analysts. But on the other end, there are momentum traders that follow trends. But by the way, the dirty little secret of Wall Street is that exists in hedge fund land. The reason why this GameStop trade has caused so much pain is because at the top of the pecking order was Melvin Capital. Those guys were incredible stock pickers. They are incredible fundamental modelers of companies. Okay, Gabe Plotkin is one of the sort of giants of our era, of my era, right? But at the end of the day, what happens is, irrespective of what he puts on, his trades are mimicked and copied by umpteen other hedge funds that follow along. For every LP that can't get into Melvin, they get into a copycat fund that works basically like Melvin. And so when the trade goes against him, then it goes against all these people all at the same time. So the reality is there are fundamental momentum investors in the market that are organized capital, i.e. hedge funds, and disorganized, loosely affiliated capital, i.e. Wall Street bets. And I think what you're seeing is the push and pull of that, and the realization should be that if every person was forced to publish their fundamental research, it would be hard to distinguish the best version of research from Wall Street bets and the best version of research from a hedge fund. They don't have an edge. And this is what you're exposing, is that edge is gone. And now all of a sudden, retail can be on the same footing and they don't have to be the bag holder to Wall Street. But, it's not my job to go and defend a bunch of, highly compensated hedge fund managers against losses. And just the fact that for one time those folks lost, we can bellyache and cry on national television, to me is a joke.
So the key point here is that Wall Street is looking at this situation as just a bunch of idiots on Reddit coordinating together and deciding to stick it to the man and YOLOing into this ridiculous investment. But as you actually take the time to research into this, it's just not true. The original poster on Reddit, who goes by the tag DFV, has been providing his analysis about the company GameStop for a long time now. In fact, I even talked about how Michael Burry from The Big Short was invested into GameStop back in May 2020. At the time I released that video, GameStop was around about $4 per share, so congrats if you saw that and you did get in early. In the past few months, Ryan Cohen recently acquired a large stake in GameStop. Now, Cohen started the company Chewy years ago and later sold it to PetSmart for $3.3 billion in 2017. So he knows a thing or two about business. He invested earlier in 2020 and then upped his stake shortly before Christmas, bringing his total investment to $76 million. Shortly beforehand, in November, he had penned a letter to the company's board calling for a strategic review to create a credible roadmap for limiting costs, prioritizing profitable retail locations, and building its e-commerce wing. So while GameStop might have been in a long-term decline, and many viewed them similarly to Blockbuster, Cohen was aware of this, and the company had plans to revitalize. So this idea that this movement started with no fundamental analysis, it's just not true. But there's another, even more important piece of analysis which we haven't even touched on yet. I'll pass it back over to Chamath to explain.
I think this is an example of if you are going to so massively oversell a company to the extent that you're selling 40 more shares of that company that don't exist, and all of a sudden other folks are like, hey, wait a minute, this is going to get squeezed, and they buy it, that's just a smart trade. Retail saw it, Wall Street missed it, and they paid the price. So maybe, to your point, Scott, what regulators should do is say, hey, wait a minute, how can we allow companies to be 140% short? That doesn't make any sense. Maybe that's what should happen.
You think this overall situation is fine for the market?
The point is, just because you're wrong doesn't mean you get to change the rules, especially when you were wrong, you got bailed out the last time. That's not fair.
So his comment saying that just because you were wrong doesn't mean you can change the rules. It is so spot on. But what I really want to focus on is his point where he mentions that regular investors spotted a smart trade and decided to carry out something known as a short squeeze. So what is a short squeeze? Let's say you look at the market tomorrow and you decide that you think Facebook shares are going to drop in value. They're not going to go up, you think they're going to go down. If you want to bet on the shares dropping, you can short them. So what you'll do is you'll borrow shares from someone else and then you'll sell those shares today. Later on in the future, you have to give those shares back to the person you borrowed them from. So let's say 6 months down the line, you'll need to rebuy those same shares. If the shares have fallen in value, they'll be cheaper when you go to buy them back. Now the difference is going to be your profit. If, however, the shares have gone up in value in the meantime, you'll have to buy them back still, but you'll be paying a higher price. And that means you've made a loss. If that's confusing, don't worry. Basically, when you bet on something to drop in value, obviously, if it goes down, you make money because you were right. If it goes up, you were wrong, so you lose money. But listen, here's where it gets interesting. With typical investing, when you're betting on something going up, the worst case scenario is that your investment just goes to zero. Facebook shares, they just go to zero and you've lost everything. However, when you bet on the price of something to go down, in theory, there is no limit to how much you can lose because there is no limit to how high the share can rise in value. At a certain point though, if the share price goes too high, the people you borrowed the share from, they might approach you and say something like, yeah, we're really not comfortable you're going to be able to pay us back in the future. At this rate, you might go out of business. So in order to cover your position, you actually need to go out and buy some shares. As a result, when you buy, you end up pushing the price up along with everyone else who's also buying it. This is what's known as a short squeeze, and it basically means that people who are shorting the market, they're squeezed out of their position, and the share price will usually explode upwards with virtually nobody selling, and even the people who think the price is going to go down, those people shorting it, even they have to buy. But why does any of this matter? Well, because in the original post on Reddit in September 2020, it was noted that GameStop was the most shorted stock on the whole market, with more than 100% of its shares betting on the price going down. Therefore, it wouldn't take much upward momentum to cause a short squeeze and push the price higher. In other words, this wasn't luck, it was planned. Say what you like about it, but having the option to bet on a short squeeze happening is the definition of capitalism and having a free market. Having the knowledge and the ability to spot the trade in the first place, that requires intelligence. The kind of intelligence that Wall Street doesn't think that retail investors can have. Also, Wall Street frequently carries out this type of trade themselves. So, why can't the regular guys? Well, you might be thinking to yourself, that makes sense, but with this many investors working together, isn't it collusion? And I mean, of course, Wall Street would never do anything like that. Well, let's continue with the interview.
I'm not suggesting, and I'm not trying to come off that way, that I'm suggesting what's happened on Wall Street bets or what this cohort of traders is doing is wrong.
It's not.
I don't think that there's much of a difference from, and I know it's been mentioned on this network already today, but the first thing I thought of in this situation was back to the Herbalife episode, where you had a fairly sizable group of well-known hedge fund managers decide to take the other side of Bill Ackman's trade. He was, of course, short. They all went long. They made a fundamental case in their own mind, and whatever worked for them to have the conviction that they did to take that trade. Part of it was undoubtedly trying to hurt the short, who was Bill Ackman at that time. Maybe some of them did it through going to an idea dinner or whatever other forum, through personal phone calls or emails. And there was a large group of people on one side of the trade. I don't think it's any different. I don't think it's any different.
You just said it's not different. You're right. Idea dinners, that concept has existed for decades on Wall Street, where people get together in closed rooms behind closed doors and usher around names of companies, and they coalesce and decide to cooperate together. The guys on Wall Street bets just do it in the public completely transparently. In my opinion, that takes a lot more courage, because you could actually be wrong. Somebody can actually say, hey, listen, what you said made completely no sense whatsoever. And so what is the difference? In my opinion, this is the modern day instantiation of that dynamic, just writ large and at scale.
By the way, if you enjoy learning about investments in innovative technology, make sure to subscribe for 2 new videos like this every single week. Okay, back to it.
The only thing I'm concerned about is that there are inevitably going to be people who get hurt. I'm not talking about hedge fund managers. I'm not talking about them. I'm talking about the people who follow people into the trade, who think that this stock is going to continue to go up, because that's what they've been conditioned to think in the pandemic.
What should we do?
Because all stocks go up, apparently.
What should we do? Not allow folks. Here's what will happen if you follow your logic, then you'll say, you know what? Retail doesn't know what they're doing. I think you're wrong. Then the thing will be, retail shouldn't be allowed to participate in the stock market. I think you're wrong. And then you know what will happen, Scott? The inequality gap will grow and grow and grow. Because then what are they supposed to do then? Buy an ETF, a passive fund? They can't buy into hedge funds because the rules don't allow them to. So now, systematically, what you've done is you entrench poverty.
According to a study in 2019, the average lottery consumer in the US loses $1,038 annually on tickets. Meanwhile, the average return for investing in a venture capital firm is a positive 25%. One of those is considered too risky for the average person to invest into, while the other isn't. Somehow, in spite of every piece of data, a regular person could buy a lottery ticket where the odds are clearly stacked against them, but they can't invest in a business until the business has grown large enough to go public. Now, I mean, when Wall Street uses arguments that they're trying to protect regular investors in this situation, clearly it's a joke. And to top it all off, platforms like Robinhood stop people from being able to buy shares in Gamestop for a period of time. That is literally the opposite of capitalism and a free market. Since that decision, the company has come out and said that this happened as a result of their market makers not having enough funds. And it wasn't because of any connections they might have to companies like Citadel, who were losing money from all of this. Now, I don't know enough to say if there's a truth to this or not, but stopping people from buying a share and still allowing them to sell so the share price could only fall, it doesn't matter the situation, it doesn't matter the reason. Again, it's an absolute joke. And this all goes back to something I've talked about for years now: decentralization. Removing the middleman, Robinhood in this case, is the solution in situations like this. If there is no middleman, there is nobody who can cut off trading in a free market. In recent videos, I've talked about decentralized finance. In fact, back in July 2020, I shared this video with you talking about decentralized finance. At the time, there was only $2.3 billion in the entire industry. Today, that value sits at just under $27 billion, a 13 times increase in just 6 months. Like I said at the time, I am not always going to be right on this channel, but I will always show you things which I believe have potential. Today, there are decentralized platforms such as Synthetics or Mirror Protocol, which allow people to trade US stocks with no middleman. Back in 2017, cryptocurrency was promising, but it had little to really show for it. Today in 2021, I mean, we're still early. I'm not going to sit here and say that these projects offer perfect solutions, because honestly, they don't. But what they do is they give us an insight into the future. A future which we clearly need now more than ever. Now, when it comes to GameStop shares, AMC, or investing in silver, I don't personally hold any GameStop or AMC. I do hold a tiny amount of silver, but those are part of long-term holdings. I haven't bought any more recently, and I have no plans to sell anytime soon. I don't know about you, but I'm personally sick of Wall Street. I think it's an absolute joke. There is so much fuss being made about Reddit users getting a win when they played by the exact same rules that Wall Street has been playing by for so many years. At the same time, I don't think this squeeze on prices is sustainable, and I worry that a lot of regular people are going to lose money in this. Now, I think the part of having freedom is that you have the choice to take that risk if you choose, and no one can tell you otherwise. But all I would say though is that there is a sustainable solution, building a fairer version of finance through blockchain. So if you take one thing away from this, it would really be go and learn about decentralized finance. I think you will be shocked at the developments that you'll find. Either way, let me know your thoughts. Have you invested in GameStop, AMC or Silver? Have you researched decentralized finance? Are you just sick of how this story is being covered by certain news outlets? Let me know. Subscribe if you want to see 2 more videos like this every week. Thank you for watching, and I will see you again very soon.